Before you even think about making an offer, ask yourself this. Why are so many experts suddenly warning buyers to be cautious in Illinois? That question alone should make you pause. Across the state, home prices have climbed quickly. Bidding wars have returned in certain areas, and listings are sitting at numbers that don't always match local incomes. Some buyers feel pressure to act fast, fearing they'll miss out, while others worry they're stepping into a market that feels uncomfortably familiar. If you've heard echoes of past housing booms, you're not alone. This video isn't about panic. It's about awareness, because understanding what's happening now can protect you from expensive mistakes later. Another hook that's catching attention is how uneven the Illinois housing market has become. While some towns remain relatively stable, others are seeing price jumps that feel disconnected from reality. When homes rise faster than wages, taxes, and long-term demand, it raises an important red flag. Many buyers are asking whether these prices reflect genuine growth or temporary hype driven by low inventory, investor interest, and post-pandemic migration patterns. This uncertainty is exactly why people are being told to think carefully before buying, especially in certain cities that are showing classic signs of overheating. A third reason this conversation matters is timing. Real estate cycles don't announce themselves clearly, but they leave clues. Rapid price appreciation, shrinking affordability, and rising property taxes often appear together when a market starts stretching beyond its fundamentals. Illinois, with its mix of urban centers, suburbs, and smaller cities, offers a perfect case study of how local factors can amplify national trends. Understanding those local conditions is key, because not every city faces the same risks, even within the same state. Finally, there's the emotional side of buying a home. Fear of missing out can push people into rushed decisions, especially when headlines talk about hot markets and limited supply. But smart buyers step back and ask whether the numbers make sense long-term. This video is designed to give you that pause, to explain why some Illinois cities are being watched closely and what warning signs buyers should understand before committing to one of the biggest purchases of their lives. To understand why certain Illinois cities may be facing housing bubble risks, we need to look at what actually defines a housing bubble. It's not just high prices. A bubble forms when home values rise significantly faster than local income growth, rent levels, and economic expansion. In these situations, prices are often supported by speculation rather than sustainable demand. Buyers may assume values will keep rising simply because they always have, but that assumption can be dangerous when conditions change. In Illinois, several factors have contributed to rising prices in select areas. Limited housing supply has played a major role, especially in cities near major job centers. New construction hasn't always kept pace with demand, pushing buyers to compete aggressively for existing homes. Low interest rates in recent years also fueled purchasing power, allowing buyers to bid higher without feeling the immediate cost. However, as borrowing conditions shift, those higher prices don't always feel as comfortable anymore. Property taxes are another major piece of the puzzle. Illinois already has some of the highest property taxes in the country, and in cities where home values rise quickly, tax burdens often follow. That means the true cost of owning a home can increase significantly over time, even if mortgage payments remain fixed. Buyers who stretch their budgets may find themselves struggling later, especially if market conditions soften or household income changes. Investor activity has also influenced certain markets. When investors purchase homes to rent or flip, prices can rise faster than local residents can afford. This doesn't automatically mean a crash is coming, but it does add volatility. Markets dominated by investors tend to react more sharply when conditions shift, because investment decisions are often driven by returns rather than long-term residency. It's important to be clear. This video is not claiming that Illinois is heading toward an inevitable collapse. Instead, it highlights cities where warning signs deserve attention. Real estate is local, and even within a single metro area, conditions can vary dramatically. Some neighborhoods may remain resilient, while others could see corrections if demand cools or affordability becomes too strained. As we move forward in this series, We'll break down specific Illinois cities that are showing these warning signs. We'll look at what's driving prices, how affordability has changed, and why experts are urging caution in those areas. The goal isn't to scare you. It's to help you make informed, confident decisions in a market that's become increasingly complex. If you're a buyer, this information can help you decide where to slow down and ask more questions. If you're a homeowner, it can help you understand your local market better. And if you're just watching trends, it offers a clearer picture of what's really happening behind the headlines. Illinois real estate still holds opportunities, but only for those willing to look beyond the hype and think carefully before they buy. If you think housing bubbles only happen in massive coastal cities, Illinois suburbs might surprise you. Some of the strongest warning signs today aren't coming from downtown skylines, but from once safe suburban markets where prices have quietly raced ahead of reality. Buyers are drawn in by good schools, commuter access, and a reputation for stability. But beneath the surface, the numbers are starting to raise concerns. This is where many people let their guard down, and that's exactly why these areas deserve a closer look. One major hook buyers should pay attention to is how quickly affordability has changed in just a few years. In several Illinois suburbs, home prices have jumped far faster than local household incomes. That gap matters. When prices rise without matching wage growth, buyers rely more heavily on low interest rates and optimistic assumptions about future value. If either of those shifts, the pressure builds quickly. What once felt like a smart long-term purchase can suddenly feel stretched. Another red flag is how competitive these markets became almost overnight. In some suburban cities near Chicago, bidding wars returned with intensity, pushing buyers to waive inspections or overextend financially just to secure a home. While competition alone doesn't mean a bubble, it becomes risky when urgency replaces careful decision-making. When buyers feel rushed, they're less likely to question whether a home's price truly reflects long-term value. A third hook lies in property taxes, an issue that hits Illinois especially hard. As home values rise rapidly, tax assessments often follow. Many buyers focus on purchase price and mortgage payments, but underestimate how sharply taxes can increase over time. In high-tax suburbs, that extra monthly burden can quietly erode affordability, especially for middle-income households. This factor alone can cool demand faster than many people expect. Finally, there's the assumption that suburbs are always safer than cities when markets shift. Historically, that hasn't always been true. Suburbs that grow rapidly during boom periods can be among the first to feel pressure when affordability tightens. Understanding which Illinois suburbs are showing these patterns is critical for anyone thinking about buying right now. One of the most closely watched areas is Naperville. Long considered one of Illinois' most desirable cities, Naperville offers strong schools, amenities, and access to Chicago's job market. However, those advantages have pushed prices to levels that now concern some analysts. Over the past few years, median home prices have risen sharply, while income growth has been far more modest. Buyers are paying a premium not just for homes, but for reputation, and that premium can be risky when market conditions change. Another city raising eyebrows is Aurora, particularly in neighborhoods close to transit and new developments. Aurora has benefited from spillover demand as buyers look for alternatives to higher-priced suburbs. But rapid appreciation combined with increased investor interest has added volatility. When investors enter suburban markets, prices can rise quickly, but demand can also retreat just as fast if returns weaken. That dynamic makes markets like Aurora more sensitive to shifts in interest rates and rental demand. Joliet is another example where affordability pressures are becoming harder to ignore. Once seen as a more budget-friendly option, Joliet has experienced notable price growth while still facing economic challenges in certain areas. When home prices rise faster than local job growth and income stability, it creates a fragile balance. Buyers may assume prices will continue climbing, but markets tied closely to local employment can react sharply during economic slowdowns. In Elgin, the story is similar. Increased demand from buyers priced out of closer-in suburbs has pushed values upward, especially in newer or renovated neighborhoods. While this growth reflects genuine demand, it also raises questions about sustainability. If price growth outpaces what long-term residents can afford, demand becomes increasingly dependent on outside buyers, a condition that can reverse if economic conditions tighten. These cities don't share identical risks, but they share a common theme: prices moving faster than fundamentals. That doesn't mean a crash is inevitable, but it does mean buyers should slow down and look closely at the numbers. How much of the price increase is driven by lasting demand, and how much is driven by temporary market conditions? That distinction matters more than ever. It's also important to recognize that housing bubbles rarely look obvious in real time. They often feel justified, supported by good schools, strong locations, or limited supply. But when multiple warning signs appear together, rising prices, strained affordability, higher taxes, and investor activity, the risk increases. Illinois suburbs are not immune to these forces, even those with strong reputations. For buyers, the takeaway isn't to avoid these cities entirely. It's to approach them with caution, patience, and a long-term mindset. Ask tough questions. Compare prices to rents. Factor in taxes and future costs. And most importantly, resist the pressure to rush. Markets reward informed buyers far more than emotional ones. When people hear housing bubble, they often picture massive metro areas or wealthy suburbs, but some of the most overlooked warning signs are emerging in Illinois' mid-sized cities. These markets don't always grab headlines, which makes them especially dangerous for buyers who assume they're automatically safer or more affordable. The truth is, rapid price growth in smaller markets can sometimes carry even greater risk because there's less economic cushion if conditions change. One powerful hook buyers should pay attention to is how quickly these cities shifted from affordable to expensive. In several mid-sized Illinois cities, homes that once attracted budget-conscious buyers are now selling at prices that would have seemed unrealistic just a few years ago. When price growth happens faster than local job creation or wage increases, it creates an imbalance. Buyers may not feel it immediately, but that imbalance often shows up later through slower sales, price stagnation, or sudden corrections. Another warning sign is dependence on a narrow economic base. Many mid-sized cities rely heavily on a limited number of employers or industries. When housing prices rise on optimism rather than diversified economic growth, markets become more vulnerable. If a major employer downsizes or relocates, demand can soften quickly, leaving recent buyers exposed. Unlike larger metros, these cities don't always have multiple economic engines to absorb shocks. A third hook lies in migration patterns. During recent years, buyers moved into smaller cities seeking lower costs and more space. That influx pushed prices higher, but may not be permanent. If remote work trends slow or commuting expectations change, demand could shift again. Markets built on short-term migration trends are often more sensitive than they appear on the surface. Finally, there's the psychological factor. In mid-sized cities, rising prices can feel validating rather than concerning. Locals may see appreciation as long overdue recognition, and buyers may assume they're getting in early. But when prices rise too fast, optimism alone can't sustain values. Understanding this distinction is critical before buying into markets that feel up and coming. One city frequently mentioned in housing discussions is Rockford. Historically known for affordability, Rockford has seen notable price increases in recent years. While some growth reflects renewed interest and redevelopment efforts, prices in certain neighborhoods have climbed faster than income growth. For buyers, the concern isn't that Rockford lacks potential. It's whether current prices accurately reflect long-term economic strength. When affordability erodes too quickly, demand becomes fragile. Peoria presents another interesting case. As a regional hub with healthcare, education, and manufacturing ties, Peoria offers real economic value. However, home prices in desirable areas have risen sharply, even as population growth remains modest. When prices rise faster than population or income trends, it raises questions about sustainability. Buyers paying premium prices may be assuming future growth that hasn't yet materialized. In Bloomington Normal, housing demand has been influenced by stable employers and a strong university presence. While these factors provide support, rapid appreciation still carries risk. College towns and employer-centered cities can experience sudden shifts if enrollment changes or corporate strategies evolve. When buyers stretch budgets based on stability assumptions, they may underestimate how quickly conditions can change. Champaign-Urbana faces similar dynamics. Demand driven by the university has pushed prices upward, particularly for newer homes and rentals. Investor activity has also played a role, especially in neighborhoods close to campus. While student demand offers consistency, it can also amplify volatility. If rental markets cool or investor interest declines, prices may face downward pressure. These cities are not destined for collapse, but they share a common pattern: price growth moving ahead of fundamentals. In mid-sized markets, that gap matters even more because demand pools are smaller. When fewer buyers can afford rising prices, markets can cool quickly. Sellers may hold firm initially, but prolonged stagnation often leads to price adjustments. Another overlooked factor is infrastructure and tax burden. Illinois cities already face fiscal challenges, and mid-sized cities often have fewer resources to offset rising costs. When home values increase, property taxes can follow, putting additional strain on homeowners. Buyers who focus only on purchase price may overlook long-term affordability challenges tied to local budgets. For buyers considering these cities, caution doesn't mean avoidance. It means preparation. Research employment trends. Compare price growth to income growth. Look at population movement, not just recent sales. And consider how dependent the local market is on a few key drivers. These steps can make the difference between a smart investment and a stressful overextension. As we continue, we'll explore Illinois cities where urban pressures, taxes, and shifting demand create another layer of risk. These areas often look strong on paper, but face challenges that buyers don't always see up front. Understanding those risks is essential before making a long-term commitment. When buyers think about Illinois housing risks, urban markets often feel like the safest bet. Big cities usually mean jobs, infrastructure, and long-term demand. But even large urban centers can face housing bubble pressures, especially when affordability begins to break down. In Illinois, several urban markets are showing signs that prices may be stretching beyond what many residents can realistically sustain. One major hook in urban housing markets is the growing gap between home prices and household income. In cities where wages haven't kept pace with rising housing costs, buyers rely more on optimism than math. That imbalance doesn't always show immediate consequences, but it builds pressure over time. When enough households are priced out, demand weakens, and prices lose their support. Another warning sign is rising ownership costs beyond the mortgage. In Illinois cities, property taxes, insurance, and maintenance costs add significantly to the total cost of ownership. Even buyers who lock in fixed mortgage rates may see monthly expenses climb steadily. This hidden affordability problem is especially risky in urban markets where taxes and fees are already high. A third hook is population movement. Some Illinois cities have faced slow or negative population growth, while home prices have still increased. That combination deserves attention. Prices can rise temporarily due to limited supply or investor interest, but without population growth, long-term demand becomes harder to sustain. When prices outpace population trends, markets become more vulnerable to corrections. Finally, urban markets often attract investors seeking rental income. While this can support prices in the short term, it can also amplify volatility. Investors tend to react quickly to changing conditions. If rents soften or expenses rise, investor-driven demand can retreat, leaving owner-occupiers exposed in a shifting market. Chicago sits at the center of Illinois' housing conversation. As the state's largest city, it offers diverse neighborhoods, strong cultural appeal, and economic opportunities. However, affordability has become a growing concern. In many parts of the city, Home prices have risen despite long-standing challenges such as high taxes, budget pressures, and uneven population trends. Buyers are increasingly selective, and price growth has slowed in areas where affordability limits are being tested. In certain Chicago neighborhoods, price appreciation has been uneven. High-demand areas continue to attract interest, while others see longer listing times and price adjustments. This divergence suggests a market that's becoming more fragile beneath the surface. Buyers assuming uniform growth across the city may overlook localized risks. Evanston, just north of Chicago, presents another urban-adjacent example. Known for its amenities and proximity to the city, Evanston has seen rising prices that challenge affordability. Strong demand has supported values, but high taxes and limited supply have pushed costs upward. When ownership becomes accessible only to higher-income buyers, markets grow narrower, and narrower markets are more sensitive to change. Oak Park reflects similar pressures. Its appeal lies in historic homes, transit access, and community amenities. But price growth combined with taxes and renovation costs has increased the barrier to entry. Buyers who stretch budgets to enter these markets may find themselves with limited flexibility if economic conditions shift. Cicero and other near-city areas also face a delicate balance. Increased interest from buyers priced out of central neighborhoods has pushed values higher. While this demand reflects genuine need, it can fade if affordability thresholds are reached. Markets built on spillover demand must maintain a careful balance to remain stable. Urban housing markets also face policy and fiscal uncertainty. Changes in taxes, regulations, or public spending can influence buyer confidence. In Illinois, these factors carry extra weight due to long-standing fiscal challenges. When buyers factor in long-term costs, some may choose to delay or relocate, softening demand further. For buyers considering urban Illinois cities, awareness is critical. Strong demand doesn't eliminate risk, it reshapes it. Buyers should examine not just neighborhood appeal, but long-term affordability, tax trends, and population movement. Urban markets can remain resilient, but only when prices align with economic reality. As we move toward the final part of this series, we'll look at how all these patterns come together and what buyers, sellers, and homeowners should realistically expect going forward. Understanding the bigger picture can help you navigate Illinois housing markets with confidence instead of fear. After examining suburban, mid-sized, and urban Illinois cities, one truth becomes clear. Housing bubbles aren't defined by panic. They're defined by pressure. And pressure builds quietly. Buyers often don't realize it until affordability breaks, demand slows, or market conditions shift. That's why the most important takeaway from this series isn't fear, it's preparation. Understanding the warning signs now can help you make smarter decisions, regardless of where the market goes next. One powerful hook for buyers is recognizing that rising prices alone don't guarantee long-term value. In many Illinois cities we've discussed, prices have increased faster than wages, population growth, and local economic expansion. That disconnect doesn't always lead to a dramatic crash, but it does increase the risk of stagnation or gradual correction. Buyers expecting rapid appreciation may be disappointed if values level off while ownership costs continue rising. Another key hook is timing expectations. Many buyers assume they need to act immediately or risk missing out forever. But real estate markets move in cycles, not straight lines. When affordability tightens, demand naturally cools. Buyers who rush often absorb the most risk, while those who wait and negotiate carefully tend to gain leverage. In Illinois, where taxes and long-term costs are significant, patience can be just as valuable as opportunity. A third hook centers on total ownership cost, not just purchase price. Mortgage payments are only one piece of the puzzle. Property taxes, insurance, maintenance, utilities, and future assessments all add up. In markets showing bubble-like pressure, these costs can increase even if home values slow. Buyers who plan only for today's payment may struggle tomorrow. Long-term affordability should always guide short-term decisions. Finally, there's the emotional aspect. Homes are personal, and emotions often override logic. But the strongest buyers are those who separate desire from data. They ask hard questions, analyze trends, and resist hype. Illinois still offers great places to live, but not every market makes sense at every price. So what should buyers actually do? First, research local fundamentals. Look beyond headlines and examine income growth, job stability, population trends, and new housing supply. Markets supported by strong fundamentals tend to be more resilient, even when prices pause or adjust. If price growth outpaces these factors, caution is justified. Second, compare owning versus renting. In some Illinois cities, monthly ownership costs now exceed comparable rents by a wide margin. That gap matters. When renting becomes significantly cheaper, it often signals that prices have moved ahead of sustainable levels. Buyers should view this comparison as a reality check, not a deal breaker, but an important signal. Third, avoid stretching your budget to the limit. Buying at the top of your affordability range leaves little room for change. Interest rates, taxes, and life circumstances don't stay fixed. Buyers who leave financial breathing room are better positioned to weather market shifts without stress. For current homeowners, this information isn't a warning to sell. It's a reminder to stay informed. Markets evolve, and understanding local conditions helps homeowners plan realistically. Equity built during strong markets is valuable, but should be managed wisely, not assumed to grow endlessly. For investors, Illinois markets demand selectivity. Not all growth is equal, and not all demand is permanent. Investors who rely solely on appreciation rather than cash flow may face challenges if markets stabilize. Sustainable investments prioritize fundamentals over hype. Ultimately, Illinois housing markets are not facing one single outcome. Some cities may cool gently, others may adjust more noticeably, and some may remain stable. The difference will depend on local conditions and buyer behavior. What matters most is approaching the market with clarity instead of urgency. If there's one message to remember, it's this: think before you buy. Ask questions, run the numbers, and don't let fear or excitement make the decision for you. Smart buying isn't about predicting the future perfectly. It's about preparing for it responsibly.